Right now, in Shanghai, physical silver is trading at a premium over 11% above Western prices. Warehouse inventories have hit decade lows, and China has just restricted silver exports to the outside world. The question everyone on Wall Street should be asking, is a price shock already underway, and are we too late to act? To understand what's happening, we need to start in Shanghai, home to the Shanghai Futures Exchange and the Shanghai Gold Exchange. These are two of the world's most important physical silver trading hubs, representing China's massive appetite for the white metal. China is the world's largest industrial consumer of silver, from solar panels to electronics to electric vehicles, and for years, it has also been one of the largest producers, but something has shifted. By November 2025, silver stockpiles on Chinese exchanges had fallen to their lowest levels since 2015. Not because supply suddenly vanished, but because demand absolutely exploded. The solar industry alone has become a voracious consumer, using silver in photovoltaic cells at a pace the market wasn't built to sustain. Now let's talk about where silver comes from and why the supply side is cracking. The world's top silver-producing nations, Peru and Mexico, have been hit by political instability, rising costs, and declining ore grades. Mining is a slow business. New projects take 8 to 12 years from discovery to production. You simply cannot flip a switch and produce more silver when prices rise. Here's a stat that should shock you. COMEX registered silver inventories in the United States are down nearly 70% since 2020. The London Bullion Market Association has lost around 40% of its vault holdings. And in Shanghai, inventories have hit a 10-year low. That's not a blip. That's a structural collapse in physical availability, and making things dramatically worse. Starting January 1, 2026, China implemented new export restrictions on refined silver. Under the new rules, only large state-approved companies can export silver, and only after obtaining a special government license. This has effectively blocked hundreds of smaller suppliers who long served global industrial buyers. The result? A self-reinforcing shortage cycle. China is keeping its silver at home. This brings us to the most telling signal in the entire silver market right now, the Shanghai Premium. As of early 2026, physical silver in Shanghai is trading at roughly $86 to $87 per ounce, while the Western spot price sits near $78. That's an 11% premium, and in late 2025, at its peak, the gap stretched to over 34%. What does that tell us? It tells us that buyers in China are so desperate for actual, physical metal that they are willing to pay a massive premium. This isn't speculative noise. This is physical scarcity showing up in price. Analysts call this situation backwardation, where spot prices are higher than futures prices. It's the market's way of screaming, we need silver now, not later. Rising silver lease rates and borrowing costs reinforce this. It is becoming genuinely difficult to borrow or deliver physical silver in China, and that pressure is spreading globally. Animated, explicable of futures contracts versus physical bars. Vault imagery. Here's where the story gets really interesting and potentially explosive. For decades, the global silver market has been dominated by paper contracts, futures, forwards, ETFs, and derivatives. These instruments represent claims on silver, not actual silver itself. And for most of market history, that worked fine, because not everyone wanted physical delivery at the same time. But today, estimates suggest the paper-to-physical silver ratio sits somewhere near 356 to 1. That means, for every single ounce of physical silver, there are hundreds of ounces in paper promises circulating in global markets. When industrial users and institutional buyers begin demanding physical delivery instead of cash settlement, as they are now increasingly doing in Shanghai, this system comes under enormous stress. Some analysts warn this could lead to a so-called force majeure event, a moment where a major exchange cannot deliver on its silver obligations. If that happens, price discovery would shift entirely to whoever holds the physical metal, and right now, China holds a lot of it. Let's not lose sight of why all of this is happening in the first place. Demand. Silver is no longer just a precious metal for jewelry and coins. It has become one of the most critical industrial materials of the 21st century. Every solar panel contains silver. Every electric vehicle uses it. Semiconductors, medical devices, 5G infrastructure, water purification. Silver is embedded in virtually every modern technology. Metal Focus forecasts a fifth consecutive year of silver supply deficit for 2025, meaning the world used more silver than it produced. While 2026's deficit is expected to narrow slightly to around 30 million ounces, it remains a deficit. The structural imbalance is not going away. And on the investment side, demand is surging too. With uncertainty around Federal Reserve independence, concerns about U.S. dollar stability, and rising geopolitical tension, investors are increasingly turning to silver as a portfolio hedge, driving mint shortages in silver bars and coins globally. By mid-December 2025, silver had already broken through $64 per ounce, its highest level in over 40 years. The move from under $30 to over $64 was relentless. For 2026, analyst forecasts range widely, but they skew bullish. Many see a path to $100. Analysts like Peter Croth and Frank Holmes agree. Clem Chambers calls silver the fast horse. Retail investment demand alone could act as a juggernaut, pushing prices dramatically higher. Some analysts see $125 per ounce as possible if Shanghai supply shortages escalate. On the Shanghai Gold Exchange, benchmark prices already touched $86 to $87 in early 2026, suggesting the Western markets may be playing a game of catch-up. Key variables: inventory draws from Shanghai warehouses, and policy reversal from Beijing. Also, whether Western futures exchanges face delivery pressure. So what does all of this mean for the average investor? First, the usual disclaimer: this is not financial advice. Silver is volatile, and markets can move in unexpected ways. Always do your own research and consult a financial advisor. That said, the fundamentals here are unusually compelling. A structural supply deficit, a physical shortage in the world's largest consuming nation, export restrictions reducing global supply, industrial demand keeps accelerating, and a paper-to-physical ratio becomes more dangerous. For those looking to gain exposure, options range from physical silver bars and coins, to silver ETFs like SLV or PSLV, to silver mining stocks. Each comes with its own risk profile, and the choice depends on your investment horizon and risk tolerance. The critical thing to understand: the Shanghai market is no longer a distant data point. It is increasingly the pulse of global silver. What happens in those warehouses, whether inventories recover or continue to drain, will determine whether the world sees $80 or $120 silver. The age of cheap silver may be ending, and the market is just beginning to wake up to that reality. If you found this breakdown valuable, hit like and subscribe. We'll be covering silver, gold, and commodity markets every week as this story develops. Drop your thoughts in the comments. Do you think silver hits $100 in 2026? Let's talk about it. Until next time, stay sharp, stay informed.